Hello and welcome to the Bulletin with UBS on Monocle Radio. Each week the sharpest minds and freshest thinkers in finance take you beyond the numbers and hype, right to the heart of the big issues of the day. In this week's edition of the programme, we're taking a look at UBS Asset Management's flagship thought leadership paper, The Red Thread, the most recent edition of which is a deep dive into diversification. Now, this has long been a central tenet of investment theory. Think of the old idiom, don't put all your eggs in one basket. But these assumptions have been sorely tested of late, due perhaps to the dominance of the so-called Magnificent Seven tech companies, including the likes of Google, Apple and Tesla. So, arguably, if you diversified your equities portfolio, it could result in de-worsification. In this show, then, we'll look at diversification within and across asset classes. And, stepping away from investments, we'll consider why companies haven't really diversified their supply chains, despite factors ranging from extreme weather events to the global pandemic. To examine all these issues, I'm delighted to say we're joined by three of the key figures behind this edition of The Red Thread. Barry Gill, UBS Asset Management's Head of Investments, Lucy Thomas, Head of Sustainable Investing and Impact, and Michele Gambera, Head of Strategic Asset Allocation. Barry, Lucy, Michele, a warm welcome to you all. Barry Gill, perhaps let's start with you. So much interesting research here. Tell me, why now to take this deeper dive into the theme of diversification?
To be honest with you, I think it's because we're at this super interesting point in history. We've got this incredible amount of concentration taking place in equity markets. Let me just give you a flavor for this. The most highly valued stock on the New York Stock Exchange today is valued 800 times. The market cap is 800 times larger than the 75th percentile stock. This hasn't happened since the top of the 1929 bull market, right? In addition, the top 10 stocks in the market today are at the highest level of concentration. And I'm referring specifically to the US market, which has historically been a super diversified market. We're at this massive level of concentration by the top 10 stocks. To illustrate that further, the Magnificent Seven have a greater market cap combined than the entirety of the European and Japanese stock markets. So this is highly, highly unusual. So we've got incredible concentration taking place in the US. And so diversification really has not been valuable in that regard, but it goes beyond that. The concentration, the geographic concentration that we have across markets is also at incredibly high levels. So the US stock market today represents 74% of the total market cap of the MSCI World benchmark. Again, also the highest level. This is very, very unusual. And when I travel, and I just spent 3.5 or 4 weeks in Asia and Australia, it's always interesting to get the perspective of the international investor. But if you're a US investor, there's basically never been an incentive really over the last 30, 40 years to diversify outside of the US. And if you're an international investor, the only benefit of diversification you really got was the diversification that you did into the US. So that's it in the context of the stock market. Then the third point, when you're thinking about diversification and the benefits of diversification that you get from stocks versus bonds. And we've been in this very, very unusual period in history where when stocks go down, bonds go up. And we've kind of taken it for granted. So we've got this natural diversification that's taking place in the portfolio. And like I said, we take it for granted. But the reality is that that is not normal. And in general, people are fixated by the ruin that inflation brings on financial assets. And as a result, stocks and bonds are normally positively correlated. And so if we return to that normalcy, which we've actually started to see more recently, you're going to lose a lot of the natural diversification that comes in your portfolio. And I'm sure we'll touch on this a little bit later. But those are really the three reasons. This level of concentration that we're getting forces us to really ask this question, should you continue to diversify? What are the benefits of diversification? Should the old rule book be thrown out? And so that was the reason, and that's why we did all of the research.
Michele, let me bring you in here. Looking back at the lessons of history then, if we look at not just how the correlations have changed, but presumably that therefore means that the benefits of diversifying, especially with a global lens, also change over time. And Barry was saying, it is so much part of the research that you've been doing. Maybe you can tell us a little bit about how those correlations have changed and what that tells us about the benefits of diversification.
Yes, the story of correlation is actually very, very difficult to sort out because they change over time. Sometimes we don't know why. So in particular, they change between asset classes. There are some asset classes that are better diversifier in some market events and some that are better in other market events. So at the beginning, one could think simply that these relationships are unstable, but at the end of the day, we realize that there are some asset classes that are better in situations where there is a market panic, where there is an increase in the VIX that tends to just make everybody risk averse. And therefore, in these places, government bonds tend to be a really good diversifier. Sometimes gold is. In general, we see that hedge funds tend to have a low correlation with the market, and so they are good diversifiers in many of these cases. When we have inflationary spurts, then it's when probably commodities come more into the limelight because inflationary spurts are often correlated to commodity price movements. So in addition to government bonds, in addition to hedge funds, also commodities can be good diversifiers in cases of inflationary spurts, and of course, linkers as well. But I think, every time there is an episode in which these correlations kind of blow up, there is a wave of articles suggesting that diversification is dead. I think that nobody should have thought that diversification is guaranteed to work 100% of the time. The market are not a Swiss watch. And therefore, there can be noise, there can be extra factors, and there is nothing that is absolutely waterproof.
Maybe just picking up on that, what Michele is really highlighting is the lack of stability of these relationships across asset classes. But also there's a historical perspective to this as well, which is that if you went back 50 years ago, the global economy was far less interconnected than it is today. And as a result, if you were to go and start investing in frontier markets or emerging markets at that time, and into the 80s and even into the early 90s, you really were getting true diversification benefits. But if you think about how integrated the global economy is today, how integrated supply chains are, etc., a lot of those benefits have disappeared. So it's becoming a lot harder to find natural diversification, certainly within asset classes, but even beyond asset classes. And I think that's pushing people out a little bit on the risk frontier. And if you go back to what I was saying before about the loss of natural diversification that's taking place in a traditional 60-40 stock bond portfolio, investors really have their work cut out for them going forward to find ways to diversify and augment return profiles.
Well, yeah, and Michele, if I can then come back to you on that, exactly that point, it's interesting. Is it then a question of challenging some of those assumptions? Barry mentioned the old sort of 60-40 assumption. Is it also just a question of reminding investors that there is no perfect diversifying asset that will always work 100% of the time? And maybe, yes, you need to think about which specific asset classes maybe work better in times of crises, but you can't expect the same formula to work all the time. I guess that's certainly what the lessons of history tell you if you look over, say, 10, 20 years, right?
Yes, because the sources of the market volatility differ, and therefore also the solutions may differ, the best diversifiers. Of course, you could just simply buy a bunch of put options and cover your risk, but the cost of continuously rolling over the put option exceeds the return that you can expect from the markets. So that would be a way to not only eliminate volatility, but also eliminate income.
Lots of fascinating, sort of almost more of the portfolio theory so far. Lucy, let me bring you in here. Your sort of red thread piece looks at diversification, but I guess through a bit more of a sort of real world lens in a sense, and looking at the impact of events, whether that's extreme weather or the pandemic, of course, has led to people changing the way they manage their supply chains, for example. Tell me a little bit about what your research in that piece told you about the theme.
Absolutely, Tom. So as we looked at what does a diversification strategy mean for a portfolio, we thought also then about what does diversification look like for the underlying investee companies. And similar themes of concentration, resilience, looking back in history, learning and positioning for the future came up. So in history, I suppose what we've seen to date from corporates has been optimization for costs, optimization for the lowest cost supply chain that can be achieved. And that's resulted in, some extreme concentration. We've also seen, though, events where that hasn't been very successful. So let's go back to July 2011. 65 out of 76 Thai provinces were declared flood disaster zones. There was livelihoods destroyed. Also had major commercial impact. So at the time, Thailand supplied 25% of the world's hard disks. And this was a huge supply chain disruption for that industry. And what we saw was the prices doubled. It took almost 2 years for those to recover. And so it really highlighted the danger of concentration and when something happens to disrupt that supply chain. However, it didn't really change behaviors. So cost continued to remain the focus. And we asked ourselves why. And we think it's really because dimensions like globalization, free movement of goods and people, these things haven't really provided an incentivization for companies to diversify their supply chains. Let's move forward to now, and we think the equilibrium has shifted. We think it is more complex for corporates. So we know protectionism has increased. We know there's been an increase in trade barriers for goods, for labor, even for capital. And so what we see is companies starting to focus more on the resilience of their supply chains. And that, we think, will result in more diversification of those. Let's unpack 3 areas maybe of how they're diversifying across supply chains, or what's compelling them to build these more resilient supply chains. Environment, geopolitics, and social are the 3 areas that we looked at. And we think, by the way, they're very interconnected. So from an environmental perspective, something like you mentioned, physical climate risk and the catastrophic events that can come up, drought, storms, fires, all of these things can create huge economic loss and disruption in supply chains. So, for example, we know that in the period up to 2020, that decade, it was 8 times the economic loss due to physical climate risk catastrophes compared to in the 70s. So it's hugely more disruptive for corporates operating. Second area we looked at was geopolitics and how that is shaping supply chains. And a very tangible example of the influence is in tech and the CHIPS Act in the US, which effectively is a protectionist measure in the face of significant competition from China. We've got over 90% of the most advanced chips manufactured in Taiwan. So therefore, there's a strong strategic rationale for diversification. But in effect, this is public policy driving private sector behavior for diversification. And then the last area was around social. And this was really interesting when we look at labor. So I mentioned that, companies have been locating in the lowest cost locations, and that's particularly locating for low skilled labor. As we move into a more digitally enabled world, we see companies wanting to have access to labor forces that are digitally skilled. And so countries that might benefit from that could be India, Mexico, Vietnam, etc., who have that type of workforce. So the bottom line here is that there's a finer balance for companies to find across building resilience in their supply chain. But we do think there's opportunity for those who are reconfiguring for that resilience. They can improve the sustainability profile of their operations and ultimately be better prepared for these kind of tightening sustainability related regulatory environments or geopolitical events that we're seeing play out.
Barry Gill, a quick final thought from you, perhaps.
What's interesting is that the level of concentration that's taking place in markets today is not just a problem for active managers, but it's actually also a problem for index managers and clients that allocate into passive funds, because that's not actually what they wanted to buy in the first place. They elected to buy something that was heavily diversified, and they've ended up with something that's become very concentrated. And one might argue, actually, this huge amount of capital that has been chasing market cap weighted indices, it's had this sort of self-perpetuating effect. Like I said at the very start, it's an interesting point in history, and it is creating problems and challenges and questions. for all different types of investors.
Michele Gambera, let me just bounce to you quickly as well. I mean, I guess that's interesting, isn't it? If we talk at this top again about challenging assumptions, and I guess, some of these correlations are based a little bit on constant relationships, right, between variables, but variables also move, and they move in a non-linear way often. A last word on that, Michele?
Yes, correlation is a linear measure, and sometimes we don't realize that it is, and we don't realize that as investors, we would prefer situations not to be linear, particularly when stock prices go down. We would like other things to not move together with the stocks. And we observed in our statistics that there is actually a difference in movement when the market moves are extreme. So I think that might be of interest to the listeners, and it's worth considering that some of these diversifiers work differently when there are small market movements and large market movements, and that is something that can be used to the investors' benefits.
Lucy Thomas, a last thought from you too. You spoke of plenty of things that add to the risk profile, but I guess there are lots of opportunities too, right?
Absolutely, lots of opportunities, Tom. I think one of the big takeaways for us is we're big believers in active ownership and being good stewards of the capital you're looking after. So whether you're a passive investor, active investor, real assets, listed equities, we think it's incredibly important to be engaging with those underlying companies on their supply chains and understanding how they're building resilience and ultimately building a better and more resilient portfolio for yourself. So as we engage with corporates and our real assets going forward, supply chain and the different dimensions of that, whether it's climate risk, whether it's human capital, whether it's AI, are common topics that we are looking to see companies and operators managing very well.
Lucy Thomas, and before that, Michele Gambera, and of course, Barry Gill. And that brings us to the end of this edition of The Bulletin with UBS here on Monocle Radio. If you'd like to read the Red Thread in full, or any of the individual articles, head to ubs.com/the Red Thread. And you can listen again and explore more at monocle.com. That's where you can join our club and subscribe to the magazine. You can also follow this programme wherever you get your podcasts. Do also remember to discover more and find out how UBS can help you at ubs.com. This is The Bulletin with UBS on Monocle Radio. I'm Tom Edwards. Thanks for listening.